In the high-stakes arena of professional speculation, the distance between extraordinary wealth and complete ruin is measured not in market knowledge or analytical brilliance, but in the disciplined mastery of a single, often overlooked principle. The amateur trader, armed with conviction and enthusiasm, commits his capital with the reckless abandon of a gambler at the roulette table. He stakes his entire future on gut feelings and hot tips, sizing his positions based on nothing more than the depth of his conviction or the size of his account balance. He is, in the truest sense, playing a game of chance disguised as skill. The professional, however, operates according to an entirely different set of principles. He understands that the markets are not conquered through prediction or prophecy, but through the systematic application of mathematical laws that govern risk and reward. This was the revolutionary insight that transformed a young floor trader named Richard Dennis from a modest beginning into one of the most legendary speculators of the 20th century. Armed with borrowed money of $1,600, Dennis would eventually amass a fortune exceeding $350 million. But his greatest achievement was not the accumulation of personal wealth. It was the scientific proof that trading success could be taught, systematically replicated, and reduced to a precise mathematical framework. This framework centered on a single revolutionary concept that would forever change how professional money managers approach the markets: the science of position sizing. Dennis understood what most traders never grasp: that position sizing is not merely a tool for managing risk. It is the fundamental edge that separates consistent winners from the 90% who inevitably lose. We can distill the essence of his breakthrough into a systematic methodology that remains as powerful today as it was 4 decades ago. The volatility-based position sizing system, a mathematical approach so sophisticated, so contrary to natural human instinct, that it transformed complete novices into million-dollar traders in less than 2 years. This is not theoretical speculation. This is documented historical fact. The turtle traders, as they came to be known, generated an average annual return of 80% over a 5-year period, earning a collective profit of $175 million. They achieved this extraordinary performance not through superior market analysis or insider information, but through the rigorous application of Dennis's position sizing methodology. To understand this system is to understand the profound difference between gambling and scientific speculation. It is to grasp why most traders fail and why a select few accumulate vast fortunes. It is to move from the world of hope and fear into the realm of mathematical certainty. The journey of mastering these principles requires dedication and constant reinforcement. The markets have a way of testing even the most disciplined traders' resolve, especially during periods of inevitable drawdown and uncertainty. This is precisely why we have created this channel, to serve as your constant companion in the pursuit of trading mastery, to provide not just instruction, but the ongoing reinforcement necessary to maintain discipline when the markets test your conviction. If you are committed to transforming your approach to speculation from amateur gambling to professional methodology, subscribe to this channel. Return to these lessons regularly. They are designed to fortify your resolve and sharpen your understanding when you need it most. Before we can appreciate the genius of Dennis's position sizing breakthrough, we must first examine the fatal flaw it was designed to eliminate: the arbitrary approach to bet sizing that destroys most trading accounts. The typical trader approaches position sizing with all the scientific rigor of throwing darts at a board. He might risk 2% on one trade, 10% on another, perhaps even 20% on a trade that feels particularly promising. His position sizes fluctuate based on emotion, recent performance, or simple convenience. He buys round lots because they are easy to calculate. He risks more when he is winning and less when he is losing, precisely the opposite of what mathematical logic demands. This haphazard approach to sizing creates a portfolio where risk is distributed unevenly across trades and markets. A single bad decision in a highly volatile market can wipe out months of careful gains in stable markets. Dennis recognized this fundamental flaw early in his career. He observed that traders could have superior market analysis, perfect entry timing, and disciplined exit strategies, yet still fail catastrophically due to improper position sizing. The solution required a complete rethinking of how risk should be measured and allocated across a trading portfolio. Dennis developed what he called the N system, a volatility-based approach to position sizing that ensured every trade contributed equal risk to the overall portfolio, regardless of the underlying market's characteristics. The foundation of this system rested on a deceptively simple concept: That risk should be measured not in dollars, but in units of volatility. Dennis defined N as the 20-day exponential moving average of the true range for any given market. In practical terms, N represented the average daily price movement, the normal breathing of the market over recent trading sessions. This measurement became the universal risk unit across all markets and all time frames. A single unit of risk was defined as a position size that would lose approximately 1% of total account equity if the market moved against the position by 1 N. This elegant formula solved multiple problems simultaneously. It normalized risk across different markets with vastly different price levels and volatility characteristics. It automatically adjusted position sizes as market conditions changed. Most importantly, it removed all subjective decision-making from the position sizing process. Consider the practical application of this methodology. If trading crude oil with an N value of $2, a unit position would be sized so that a $2 adverse move would represent 1% of account equity. If simultaneously trading treasury bonds with an N value of 32 ticks, the bond position would be sized so that a 32-tick adverse move would also represent exactly 1% of account equity. Despite the dramatically different characteristics of these two markets, each position contributes identical risk to the overall portfolio. This mathematical precision extended to every aspect of the system. Dennis never allowed his traders to risk more than 2% of account equity on any single trade. This meant that positions were typically sized at approximately 2 units, with stop losses placed at 1 N from the entry price. The beauty of this approach becomes apparent when examining its performance across different market conditions. During quiet trading periods, when N values are small, position sizes automatically increase, allowing traders to capitalize on low-risk opportunities with larger positions. During volatile periods, when N values expand, position sizes automatically contract, protecting the portfolio from the increased uncertainty that volatility represents. This dynamic adjustment happens naturally, without any subjective input from the trader. The system itself adapts to changing market conditions with mathematical precision. The psychological benefits of this approach are equally profound. When every position represents identical risk, traders can maintain emotional equilibrium regardless of market conditions. A loss in one market is balanced by the potential for gains in others. No single trade can inflict catastrophic damage to the overall portfolio. This emotional stability is crucial for long-term success. It allows traders to execute their methodology consistently without the fear and greed that destroy most speculative careers. Dennis proved the effectiveness of this system through the most rigorous tests possible. He recruited 23 individuals with little to no trading experience and taught them his methodology over a 2-week period. These novice traders, armed with nothing more than Dennis's position, sizing rules, and trend-following principles, went on to generate returns that established them among the most successful traders of their generation. Their success was not accidental, it was the inevitable result of applying mathematical precision to the chaotic world of market speculation. The implications of Dennis's breakthrough extend far beyond individual trading success. His methodology provides a framework for understanding risk that applies to any form of speculation or investment. The genius of Dennis's N-unit system extended into the realm of portfolio construction, where it revealed its most sophisticated application. The diversification advantage that most traders pursue through market selection, Dennis achieved through mathematical precision. Traditional portfolio theory suggests spreading risk across uncorrelated assets. Dennis understood that true diversification required something far more fundamental. It required that each position contribute identical risk regardless of the underlying market's behavior. This insight led to what became known as the portfolio heat concept. At any given time, a trader following Dennis's methodology would know exactly how much total risk was deployed across all positions. If holding 4 positions, each sized at 2 N units, the total portfolio heat would equal 8% of account equity. This mathematical certainty eliminated the guesswork that plagues most multi-market trading approaches. There was no ambiguity about overall portfolio risk, no hidden concentrations that could explode without warning. The system's sophistication became most apparent in its treatment of correlated markets. Dennis recognized that simply applying the N-unit formula to related markets could create dangerous risk concentrations. Crude oil and heating oil, for instance, might both generate valid trading signals simultaneously. To address this challenge, Dennis introduced the concept of correlated position limits, No more than 4 N units could be allocated to closely related markets at any given time. This rule prevented the illusion of diversification that comes from holding multiple positions in essentially the same underlying trend. The mathematical elegance of this approach created what Dennis called synthetic diversification. By controlling the risk contribution of each position, he could achieve true portfolio balance even when trading a limited number of markets. This principle proved especially powerful during periods of market crisis. When correlations between seemingly unrelated markets suddenly increased, traditional diversification strategies failed catastrophically. Portfolios that appeared well-balanced revealed dangerous concentrations overnight. Dennis's N-unit system remained stable because it was based on risk, not market relationships. When volatility increased across all markets, position sizes automatically contracted, maintaining consistent risk levels even as market behavior changed dramatically. The practical implementation of this system required what Dennis termed the risk budget approach. Each trading day began with a clear understanding of available risk capacity. If current positions consumed 6% of account equity, only 4% remained available for new opportunities. This discipline prevented the gradual risk creep that destroys most trading accounts. Without clear risk measurement, positions tend to accumulate beyond safe levels. Small additions here and there eventually create dangerous concentrations that only become apparent after significant damage has occurred. Dennis's traders learned to think in terms of risk units rather than profit targets. Before considering any trade, they would calculate how many N units the position would consume. Only after confirming adequate risk capacity would they proceed with execution. This reversal of traditional thinking proved revolutionary. Instead of asking how much money a trade might make, Dennis taught his students to ask how much risk it would add to the portfolio. Profit became a byproduct of proper risk management rather than the primary consideration. The system's mathematical foundation extended to the calculation of position adjustments as market volatility changed. N values were recalculated daily and position sizes were adjusted accordingly. A position that began as 2 N units might gradually become 3 N units as volatility decreased, requiring a reduction in size to maintain consistent risk. These adjustments happened systematically, removing emotional bias from position management. Traders could not hold oversized positions simply because they had become profitable. The mathematics of the system demanded continuous rebalancing based on current market conditions. The sophistication of Dennis's approach became most apparent in its treatment of pyramiding, the practice of adding to winning positions. Traditional pyramiding strategies often created dangerous risk concentrations as successful trades grew larger than originally intended. Dennis solved this problem through what he called unit-based pyramiding. Additional positions could be added to successful trades, but each addition was sized as a separate N unit. The total risk from all related positions could never exceed predetermined limits. This approach allowed traders to capitalize on major trends without compromising portfolio stability. As prices moved favorably, additional units could be added at higher levels, but the mathematical constraints of the system ensured that risk remained within acceptable bounds. The psychological impact of this systematic approach cannot be overstated. When position sizing follows mathematical rules rather than emotional impulses, traders develop what Dennis called risk consciousness. Every decision is evaluated through the lens of its impact on total portfolio risk. This mindset transformation proved to be one of the most valuable aspects of Dennis's teaching. His students learned to view markets through the perspective of risk management rather than profit maximization. This fundamental shift in thinking enabled them to survive and prosper during the inevitable periods of adversity that destroy most traders. The system's adaptability extended to different account sizes and risk tolerances. A conservative trader might limit individual positions to 1 N unit, creating a more defensive approach. An aggressive trader might use 3 N units per position, accepting higher volatility in exchange for potentially greater returns. Regardless of the specific parameters chosen, the underlying mathematics remained constant. Risk was always measured in units of volatility, positions were always sized according to mathematical formulas, and portfolio heat was always known with precision. This scalability proved crucial as Dennis's students graduated from small accounts to managing substantial capital. The same principles that worked with $10,000 continued to function with $10 million. The mathematics of risk management remained constant regardless of account size. The true genius of Dennis's system lay not in any single component, but in how all elements worked together to create what he called a complete trading methodology. Position sizing was not an isolated technique, but part of an integrated approach that included entry rules, exit strategies, and portfolio management. This holistic view of trading distinguished Dennis from his contemporaries who focused on individual techniques rather than systematic approaches. He understood that sustainable success required mathematical precision applied to every aspect of the speculation process. The legacy of Dennis's position sizing breakthrough continues to influence modern portfolio management. Sophisticated hedge funds and institutional traders employ variations of his volatility-based sizing methods, adapted for contemporary markets and enhanced by advanced computing power. Yet the fundamental insight remains unchanged. Risk should be measured mathematically, positions should be sized systematically, and emotion should be eliminated from the decision-making process through the application of proven formulas. The mathematical architecture of Dennis's N-unit system reveals itself most clearly when examining its practical application across real market conditions. The genius lay not in complex formulas, but in elegant simplicity that transformed chaos into order. Consider a trader operating with a $100,000 account following Dennis's methodology. With crude oil exhibiting an N value of $3, a single unit position would consist of approximately 167 contracts. This calculation ensures that if crude oil moved against the position by $3, the loss would equal exactly $1,000, representing 1% of account equity. Simultaneously, this same trader might hold a position in German marks with an N value of 50 ticks. The unit size for this currency position would be calculated to generate the identical $1,000 loss if the market moved unfavorably by 50 ticks. Despite the vastly different contract specifications, price levels, and market characteristics, both positions contribute precisely the same risk to the overall portfolio. This mathematical precision eliminated the dangerous guesswork that plagued traditional position sizing approaches. No longer did traders need to estimate appropriate bet sizes based on intuition or arbitrary percentages. The market itself, through its volatility characteristics, determined the optimal position size for any given opportunity. The sophistication of this system becomes apparent when analyzing its behavior during periods of changing market conditions. During the quiet summer months, when volatility typically contracts across most markets, N values decrease automatically. This reduction in measured volatility triggers an automatic increase in position sizes, allowing traders to deploy larger bets precisely when market risk is at its lowest. Conversely, during periods of market turmoil, when volatility expands dramatically, N values increase correspondingly. This expansion forces an immediate reduction in position sizes, protecting the portfolio exactly when protection is most needed. The system responds to market conditions with the precision of a mechanical governor, expanding and contracting exposure in perfect inverse relationship to market risk. This dynamic adjustment proved especially valuable during the market crashes and crises that periodically sweep through financial markets. While traditional fixed percentage position sizing approaches often resulted in catastrophic losses during volatile periods, Dennis's N-unit system automatically reduced exposure as danger increased. The mathematical elegance extended to the treatment of position additions and reductions. As winning positions moved favorably, traders following Dennis's methodology could add additional N units at predetermined intervals. These additions followed strict mathematical rules that prevented the gradual accumulation of dangerous risk concentrations. Each additional unit was sized based on current market volatility, ensuring that portfolio risk remained within predetermined bounds even as positions grew larger through favorable price movement. The system's treatment of stop losses revealed another layer of mathematical sophistication. Rather than placing stops at arbitrary price levels or percentage distances, Dennis's methodology positioned protective stops at precisely 2 N units from the entry price. This approach ensured that maximum loss per trade remained constant across all markets and time periods. A stopped-out position in soybeans would generate exactly the same dollar loss as a stopped-out position in treasury bonds, despite the entirely different characteristics of these markets. The psychological benefits of this mathematical consistency cannot be overstated. When every loss is predictable and manageable, traders can maintain the emotional equilibrium necessary for long-term success. There are no surprises, no catastrophic failures that destroy confidence and capital simultaneously. Dennis understood that most traders fail not because they lack analytical skills, but because they cannot handle the emotional stress of unpredictable outcomes. By making losses mathematically predictable, His system eliminated the fear that paralyzes most speculators during critical moments. The portfolio construction principles embedded within the N-unit methodology addressed another critical weakness in traditional trading approaches. Most traders unknowingly concentrate risk in highly correlated positions, creating the illusion of diversification while actually increasing overall portfolio vulnerability. Dennis solved this problem through what he termed the related market rule. No more than 4 N-units could be deployed across closely correlated markets at any given time. This constraint prevented traders from inadvertently creating massive exposure to single underlying trends disguised as multiple independent positions. For instance, a trader might identify valid signals in crude oil, heating oil, and gasoline simultaneously. Under traditional approaches, this trader might establish 3 separate positions, believing in the diversification benefits of trading multiple markets. Dennis's system recognized that these 3 markets represent variations of the same underlying energy complex. The related market rule would limit total exposure to 4 N-units across all energy positions, preventing the dangerous concentration that correlation creates. This mathematical approach to correlation management proved especially valuable during market crises when seemingly independent markets suddenly began moving in lockstep. Traditional diversification strategies collapsed as correlations approached unity, but Dennis's system remained stable because it had already accounted for these relationships. The implementation of the N-unit system required what Dennis called the daily risk audit. Each trading session began with a precise calculation of current portfolio heat, measuring total risk deployed across all positions. This calculation provided immediate visibility into available risk capacity. If existing positions consumed 6 N-units of risk, the trader knew exactly how much additional risk could be deployed without exceeding predetermined portfolio limits. This disciplined approach prevented the gradual risk creep that destroys most trading accounts. Without precise measurement, positions tend to accumulate beyond safe levels through a series of seemingly insignificant additions. Dennis's traders learned to think in terms of risk budgets rather than profit targets. Each potential trade was evaluated first for its risk contribution to the overall portfolio. Only after confirming adequate risk capacity would execution be considered. The system's mathematical foundation extended to the treatment of account growth and drawdown periods. As account equity increased, position sizes automatically scaled upward, allowing traders to deploy larger absolute amounts while maintaining identical risk percentages. During drawdown periods, a sophisticated adjustment mechanism came into play. If account equity declined by 10%, position sizing was reduced as if the account had lost 20%. This conservative adjustment provided additional protection during difficult trading periods when psychological pressure was at its peak. The mathematical logic underlying this drawdown adjustment recognized that trading performance often occurs in streaks. By reducing risk exposure during losing periods, the system helped preserve capital for the inevitable return of profitable conditions. This dynamic adjustment mechanism represented another departure from traditional fixed percentage approaches. Rather than maintaining constant risk levels regardless of recent performance, Dennis's system adapted to current conditions with mathematical precision. The sophistication of the N-unit methodology extended to its treatment of different market sectors and asset classes. Dennis recognized that volatility patterns varied significantly across different types of markets, requiring sector-specific adjustments to maintain consistent risk measurement. Currency markets, with their typically lower volatility and higher liquidity, received different treatment than commodity markets with their tendency toward explosive price movements. Interest rate markets, with their unique volatility characteristics driven by central bank policies, required specialized calculation methods. Yet despite these sector-specific adjustments, the underlying principle remained constant. Every position, regardless of the underlying market, contributed identical risk to the overall portfolio when properly sized according to its volatility characteristics. The practical application of these principles required sophisticated record-keeping and calculation systems. Dennis's traders maintained detailed logs of N values, position sizes, and portfolio heat levels. These calculations were performed daily, ensuring that risk measurement remained current with evolving market conditions. The discipline required to maintain these calculations proved to be an essential component of the system's success. The mathematical precision was meaningless without the operational discipline to implement it consistently under all market conditions. Dennis understood that the greatest challenge facing any systematic trading approach was not the development of sound principles, but the psychological discipline required to follow those principles during periods of adversity. The N-unit system addressed this challenge by removing subjective decision-making from the position sizing process. When mathematics determined position sizes, emotions could not override sound judgment during critical moments. This mechanical approach to risk management proved especially valuable during the inevitable periods of drawdown that test every trader's resolve. When losses mounted, the natural human tendency was to either reduce risk excessively or increase risk dramatically in an attempt to recover quickly. Dennis's system prevented both of these destructive responses through its mathematical constraints. Risk reduction occurred automatically through the drawdown adjustment mechanism, while risk increases were limited by the maximum position size rules embedded within the methodology. The result was a trading approach that remained stable and consistent regardless of recent performance or current market conditions. Success became a mathematical inevitability rather than an emotional struggle against human nature. The legacy of Dennis's position sizing breakthrough extends far beyond the specific techniques he developed. His work demonstrated that successful speculation could be reduced to mathematical principles and taught systematically to individuals without prior market experience. This insight revolutionized the field of quantitative finance and laid the foundation for the sophisticated risk management systems employed by modern hedge funds and institutional trading operations. Yet the fundamental insight remains as relevant today as it was 4 decades ago. Risk should be measured mathematically, positions should be sized systematically, and emotions should be eliminated from the decision-making process through the rigorous application of proven formulas. The markets may have evolved, trading technology may have advanced, but the mathematical laws that govern risk and reward remain constant. Dennis's N-unit methodology provides a timeless framework for navigating these eternal principles with scientific precision. The ultimate test of Dennis's N-unit methodology came not in theoretical models or back-tested simulations, but in the crucible of live market combat where real money was at stake and human psychology collided with mathematical precision. The turtle traders, armed with nothing more than these volatility-based position sizing rules, were thrust into markets that had destroyed countless experienced professionals. Yet their systematic approach to bet sizing created what Dennis called the mathematical moat, a protective barrier that allowed them to survive and ultimately thrive where others had perished. The power of this system revealed itself most dramatically during periods of maximum market stress. When the October 1987 crash sent shockwaves through global financial markets, traditional portfolio management approaches collapsed under the weight of unexpected correlations and explosive volatility increases. Traders who had believed themselves diversified across multiple markets discovered that their positions were actually concentrated bets on global financial stability. As markets crashed in unison, their carefully constructed portfolios imploded with devastating efficiency. The turtle traders, however, experienced something entirely different. As volatility spiked across all markets, their N values automatically expanded, triggering immediate position size reductions. The system that had seemed overly conservative during quiet periods suddenly revealed its protective genius during chaos. Their maximum loss per position remained mathematically constant even as market volatility increased tenfold. While other traders watched helplessly as individual positions generated losses far exceeding their worst-case projections, the turtles experienced predictable, manageable setbacks that left their capital base intact. This automatic volatility adjustment represented perhaps the most sophisticated aspect of Dennis's methodology. The system did not simply react to losses after they occurred, but anticipated dangerous conditions by measuring the market's own assessment of future uncertainty. When markets began exhibiting signs of instability reflected in expanding N values, position sizes contracted before catastrophic moves materialized. The system provided protection based on leading indicators rather than lagging damage assessment. The mathematical architecture underlying this protective mechanism can be understood through a practical example that illustrates the system's elegant simplicity. Consider a trader following Dennis's methodology during the lead-up to a major market disruption. In calm market conditions, crude oil might exhibit an N value of $1.50, allowing for substantial position sizes while maintaining the 2% maximum risk per trade. A trader with a $200,000 account could safely hold approximately 400 contracts under these conditions. As market tensions increased, perhaps due to geopolitical developments or supply disruptions, the N value would begin expanding. At $2.50, the same risk parameters would allow for only 240 contracts. At $4, the position size would contract to 150 contracts. This automatic adjustment occurred without any subjective input from the trader. The market itself, through its changing volatility characteristics, determined the appropriate level of exposure. Human emotions, which typically drive traders to increase risk precisely when danger is greatest, were completely eliminated from the decision-making process. The beauty of this approach becomes even more apparent when examining its behavior across multiple markets simultaneously. While crude oil volatility was expanding, perhaps treasury bonds were experiencing their own volatility changes in response to shifting monetary policy expectations. The N-unit system would adjust each position independently based on that market's specific volatility characteristics. The result was a portfolio where risk remained constant across all positions, despite dramatically different conditions in individual markets. This dynamic rebalancing created what Dennis termed synthetic stability. Even as external conditions changed dramatically, the portfolio's risk profile remained mathematically constant. The trader could focus on execution and analysis rather than constantly recalculating appropriate position sizes for changing conditions. The psychological benefits of this systematic approach extended far beyond mere risk management. When position sizes were determined by objective mathematical formulas, traders could not second-guess their bet-sizing decisions during periods of stress. The amateur trader, facing a promising setup in a volatile market, struggles with the eternal question of how much to risk. Too little, and he fails to capitalize on the opportunity. Too much, and he exposes himself to devastating losses if the trade moves against him. This internal debate creates paralysis at precisely the moments when decisive action is most valuable. The trader hesitates, overthinks, and ultimately either misses the opportunity entirely or enters with inappropriate sizing that reflects his emotional state rather than sound risk management principles. Dennis's students faced no such dilemma. The mathematics of the N-unit system provided unambiguous guidance for every situation. Given current volatility and account size, there was exactly one correct position size for any given trade. No debate, no emotional input, no second-guessing required. This mathematical certainty freed the trader's mental capacity for the aspects of speculation that truly mattered: market analysis, timing, and execution. Energy that would otherwise be consumed by position, sizing anxiety could be directed toward identifying profitable opportunities and managing existing positions. The system's treatment of portfolio heat management revealed another layer of sophisticated risk control. Dennis understood that the cumulative effect of multiple positions could create dangerous exposure levels, even when individual trades were properly sized. The portfolio heat calculation provided real-time visibility into total risk deployment across all positions. If a trader held 6 positions, each sized at 2 N-units, the total portfolio heat equaled 12% of account equity. This measurement enabled precise control over aggregate risk levels regardless of the number of active positions. More importantly, the portfolio heat concept prevented the gradual accumulation of excessive risk through seemingly innocent additions. Each new position was evaluated not just for its individual merit, but for its contribution to overall portfolio risk. A trader approaching maximum portfolio heat limits would be forced to either close existing positions or forego new opportunities. This discipline prevented the risk creep that destroys most multi-market trading approaches over time. This was the mathematical revolution that separated the professional from the gambler, the systematic from the emotional, the survivor from the casualty. Richard Dennis proved that the greatest edge in speculation lies not in predicting the future, but in controlling the present through scientific position sizing. His N-unit methodology transformed the chaotic art of betting into the precise science of risk management. Where others saw complexity, Dennis found elegant mathematical solutions. Where others relied on intuition, he demanded systematic measurement. The turtle traders stand as eternal testimony to this truth. Armed with nothing more than volatility-based position sizing and unwavering discipline, they conquered markets that had humbled countless professionals before them. The lesson is unmistakable. Master the mathematics of risk, and the markets will reward you with mathematical certainty.